Hello and welcome to the Mutual Fund Show on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Neeraj Shah. Today on the show, we'll discuss about the mutual fund industry getting a new benchmark against which the returns are calculated. Markets regulator SEBI on Thursday asked mutual fund houses to adopt the total return index or TRI to benchmark schemes, which is, according to a lot of people, a more appropriate way to measure the performance of such financial products. Before that, let me tell you how would TRI impact the return and the return calculations. Now, this is the Nifty compounded annual growth rate since 2000. And if you see the price return, about 11.5% CAGR. But if you look at the total return, as per the TRI calculations, it inches up about 150 basis points. So what would this do? If indeed there are schemes which over the years, as per the earlier price norm, had outperformed the index by X percentage points, 3, 4 compared to the benchmark, now those returns will start looking a bit compressed. Do you worry about it? No, you shouldn't be worrying about it. Does it do anything to the returns that you earn? No, it doesn't do anything to your returns that you earn as well. But how would it impact the way you view one, investing in mutual funds, and two, does this eventually lead to what a lot of people have been talking about in the Western world, which is the dying out, the extension or the blunting the edge of the alpha that large cap schemes generate? Let's talk about all of this and more with a very special guest, Mr. Leo Puri of UTI AMC joins us right now on the show. Mr. Puri, great having you. Thank you so much for taking the time out and speaking with us. The last few months that we've been doing this mutual fund show, there have been a number of times these queries and these discussions come about with your peers, essentially, some of whom were saying that TRI is an essential need to happen, some of whom were saying that we can do without it because it may not be the most accurate way. Now that it is finally here, what are your views on this, and how would it impact how mutual funds will be able to communicate the kind of performance that they are doing?
Well, it's a good thing. We welcome it. I think it will help make it clearer to investors where true alpha lies, and it also brings us in line with more developed markets. As you say, the difference is that in the price return index, we are only looking at the capital appreciation and ignoring dividends, whereas in total return, we're obviously adding dividends to the return. So it gives a truer and fairer picture in terms of return, and to that extent helps define alpha better, more clearly relative to passive funds. For a mutual fund, the same is true. The only difference, of course, is that as a mutual fund manager, I not only need to provide an equivalent total return, I also need to account for fees and expenses. So there is a little difference here, that when I look at my total return index in the future, I will be looking at total return net of fees and still having to deliver alpha over a passive product. So that will be an additional challenge. In addition to the 150 basis points that you mentioned, which was the difference between a price return and total return index, I will also have to justify my fees. So an investor will know very clearly and be very certain about whether or not we are delivering value through our investment process as a result of this. One other point about this transparency, while it's very helpful in terms of determining alpha, of course, the index on its own will not help an investor understand how much risk has been taken to achieve that alpha. That's a whole separate story as to how the investment style or discipline or lack of it in an investment house generates that alpha. But at least it will help clarify, the true extent of differential, which until now was not the case.
Would you, if I can ask a follow-up on that, would you presume that there might be certain quarters who might take larger risks in order to show this alpha, which of course by natural course correction as a result of the new guidelines get a bit compressed?
Yes, which is, I think the point I was alluding to is that on its own it will not provide all the information an investor needs, because you do have issues around, let's say, mandate drift, style drift, where the risks that are actually being taken and the volatility that is being incurred to generate returns is not always obvious to a lay investor. So I think as we grow more sophisticated in our tracking, we do need to also start to understand the extent to which those metrics are actually being applied so that we can properly understand alpha as it relates to risk-weighted return and not just an absolute differential. So in other words, put simply, some types of alpha are better than others, frankly, from an investor's perspective.
Well, I think that's well put. Okay, now before we move any further on this conversation with Mr. Puri, remember, as we said, while the total return on the Nifty has been 13.12% CAGR since 2000, I think Jayesh has drawn up a list of which schemes that have outperformed the total return index as well. This is just a useful indicator of the performance over the last so many years. And Jayesh, what does the data suggest?
So Neeraj, data suggests that there has been significant alpha generation as far as the Indian asset managers are concerned. So if you have a look at some of the schemes, I drew up the list of all the schemes that was, inception date was before the year 2000, and then compared the individual assets from top to down, and then came up with this list. So, the top 4 that feature on my list is the Reliance Growth Fund, which has given you a CAGR of as much as 20.84% over the last 18-19 years. HDFC Equity Fund, the other one, is about, once again, over 20% CAGR, while Franklin India has given you about 17.9%, and Birla Sun Life has given you about 17.5%. What stood out, Neeraj, for me was that, the top 10 holdings of these funds that you have are essentially in the large cap space, and they range from about 30% to 55% of the entire portfolio that, individual schemes have. Also, the other thing, I was speaking with a few other asset managers also. So, their view is that this move is essentially important and good for the overall industry, is because the developed markets generally look at the total return and not the price return. So, a right step in the right direction by, the entire industry.
Okay, Jayesh, many thanks for that. Keep in mind, what Jayesh has done is merely an illustrative example. What funds or schemes have done in the past need not be an indication of what they will do in the future. This is by no means a recommendation or trying to show that one scheme is better than the other. This is just trying to show what some of the schemes have done in the past, and compared to the total return index or total returns as well, I think Indian fund managers have managed to outperform in a big way over the last 17 odd years. The question mark only is whether this can continue. Remember, for viewers who are tuning in, we are discussing the TRI, or the total return index, and the impact that it could have on showing what the funds have done. TRI, for simplification, includes the dividends by the index as well, in addition to capital gains, and that's the difference between now or from 1st February compared to what the fund houses have been showing until now. Now, that's essentially the simple explanation of what TRI is. Maybe I've simplified it a bit more, but Mr. Puri, if I've missed out on anything, please do enlighten me, one, and our viewers as well. And two, I want to move to a rather broader topic. In the Western world, I mean, Jack Bogle, for example, has been long talking about how passive investing, ETF investing would be the way to go ahead. Now, that obviously is not true for a country like India, because still active fund managers create a significant alpha. Does this, in a way, diminish the ability of an active fund manager to show the quantum of returns that he or she can generate, even in large cap schemes? I'm not going down the mid cap schemes, we'll come there in a bit, but purely large cap funds. Does this, in a way, diminish the ability to show the outperformance?
No, it certainly does not diminish that. In fact, it will probably, to some extent, sharpen the differentiation between active and passive, but it certainly doesn't diminish the ability of active funds to outperform. And again, it will bring into strong focus the investment process and investment discipline that a particular fund house uses in order to achieve alpha. See, large cap, if you look at how an index works, essentially when you're running a passive fund, typically you'll have periods where funds that have done well and in a sense get overvalued tend to get overbought, and funds and stocks that have not done well tend to get undervalued. So over time you essentially start to get a distortion in the way that the passive indexes build up. So an active manager can clearly see through this and start to identify where value lies and shift that weightage around. So to that extent, they can start buying undervalued stocks in a contrarian fashion and vice versa, which clearly a passive manager cannot. Second point to stress is that simply buying large cap as an index constituent on its own is obviously not the full answer. Corporate governance matters a lot. The weightage in the index doesn't reflect corporate governance, and over time, a good fund manager knows that they need to track and understand corporate governance and philosophy quite closely, because that will have a bearing on the long-term ability of the stock to generate returns, regardless of their index weightage, if you like. Another issue is that in India and actually many other markets too, you will have a very large number of stocks, large cap stocks that are not in the index, which are available to managers to buy, either because of new segments coming into the market or simply because of the size of the universe. So, for example, here in India, we've had insurance companies and asset management companies come into the market at reasonable size, 20,000 crores to 80,000 crores valuations. They're not in the index at this point, but could be interesting. Gas utilities is another example. So that again becomes a source of actively sort of seeking out alpha, as it were. So for all of these reasons, large cap per se, will continue to be an active and healthy hunting ground for those seeking alpha. I'd make one other point to sort of dissipate a fallacy which I think has arisen based on recent events, which is this perception that somehow mid caps will always outperform, large caps. And in fact, in some of the examples you showed of some of the funds, by definition, 50 to 70% of the investments were actually in mid-cap companies, which you were in effect benchmarking against a large cap index. So it's a little misleading to show returns in that way, and that's one of the problems most TV channels have here, where they're actually comparing mandates which are very different against a large cap index. But the point is that there will be periods, of course, where mid caps tend to strongly outperform. You take much more risk when you do that, clearly. And there's a survivorship bias here, because when you look back, you only look at the mid-cap companies that have grown or the small-cap companies that have grown. And those that have fallen by the wayside or become shell companies tend to get ignored. So that's one problem. Second is, large-cap companies do have certain inherent advantages in terms of market position, in terms of ability to attract talent, in terms of ability to shape their industry, make investments, provide leadership, strategic leadership, and that can actually be very valuable. They also often have the ability to institutionalize higher standards of governance, not always, but in some cases. And if you are able to actually identify that, that too actually gives you an outcome which, relative to risk, could often be far superior for a typical retail investor. So we mustn't allow recency to overtake our sense of balance, if you like, in this whole debate between large cap and mid cap. And even so, within the large cap segment, there is going to be plenty of room for alpha for the reasons that I mentioned earlier. So I think it's very premature to call the death, if you like, of large cap alpha at this point. I think we have many years ahead of us where good investment managers and investment managers with disciplined investment processes will continue to identify sources of value for investors.
So I have two questions on that, Mr. Puri. Firstly, in which case would these new norms by SEBI which tell that large cap, mid cap and small cap funds have to be categorized in a way that was not done before help? Because a lot of times, I mean, I think the comparison that I think Jayesh tried to show as well was based on the category in which the fund was benchmarking itself against. So it would have some mid cap flavor, but that's a call that the fund manager has taken, not something that we've chosen to do. So would the new norms tend to help an investor discern between the pure play large cap funds versus what would arguably be called or termed a large cap fund but have a significantly large flavor of mid cap as well? Would that be beneficial to an investor, you think?
Absolutely. I think that is very better. I think these are all very investor friendly moves by SEBI. The total return index is investor friendly. I think the decision to clarify labeling in the mutual fund industry and this mutual fund categorization is also very investor friendly if it is implemented properly, as I hope it will be. I think I think this.
Okay. I hope you can hear us now, Mr. Puri. Okay, I think his earpiece has just fallen off while he just tries to adjust that. The point that I think Mr. Puri was trying to make is that the two measures are all investor friendly. He made half of the point. Mr. Puri, you made half of the point. The other point that you were trying to make, sir.
Yeah, so the point on categorization is that now you will have to define the specifications of your investment mandate much more clearly. So if you're a large and mid-cap fund, there's a clear definition around what percentage of the fund can be in large, what can be in mid, and you must adhere to that quite clearly. And that will be uniform across all fund houses, thereby reducing this arbitrage, if you like, that some fund managers had. Secondly, your index will now correlate to that particular fund mandate. So you will not be free to choose a large cap index and run a mid cap fund and then claim excessive alpha and use that to essentially push your fund to unsuspecting investors, as has happened in the past, who would not be aware of the very high degree of volatility and risk involved to generate that. You will now have to use an appropriate index, which will of course in itself narrow the alpha, because to the extent that you've been taking more risk, the index itself will reflect that those outcomes now, and you'll have to outperform against a more appropriate index. So yes, these will both, taken together, the total return index and the appropriate categorization with clear scheme mandates and clear benchmarks, I think all are very good for the long-term health of the mutual fund industry, and I think most of us welcome that as responsible manufacturers.
Okay, I'm sure. And my final question to you, Mr. Puri, and that would be on the point that you made. I think you mentioned that it's too soon to call or cast the death knell on the outperformance of or alpha from large caps, if you will. We've seen a significant rise in ETFs and ETF-linked products, so to say. Do you think this is happening because of the gush of funds coming in across classes or across the investment products, or is this more a case of investors maybe wrongly but starting to believe that large cap funds are giving as much as an index ETF would, so might as well invest in such a product? Is there a misnomer amongst the investing community right now of such nature, and does that need to be clarified? Because I think the point that you are strongly trying to make out here is that over the course of the next few years at least, large cap funds, well-managed large cap funds will still have a handsome alpha over what the index does.
Yes, I think there's still a difference here between global experience and Indian experience. I think that gush into passives is largely a global phenomenon. It's not yet an Indian phenomenon. In India, you've had the unique situation where the EPF decided to invest solely in ETFs. And frankly, about 90% of the flows into the ETFs in India have therefore been driven by a single investor. There is no widespread movement to shift from active to passive at this point in time. Having said that, I do think passive funds will play a growing role in the portfolios of many investors over time, actually, particularly if you do see the emergence of an advisory segment. And of course, that's a separate topic as to whether or not an advisory versus distribution segment of intermediaries will emerge in the Indian market. But if you do see true advisors emerge, they will often end up recommending passive funds as they construct portfolios for their clients. And they do play a useful role there. And you may be saving anything from 100 to 150 basis points in fees, which of course is not a bad amount of a margin to actually have. That means that an active fund now needs to generate that additional 150 basis points over the benchmark and over the index. Index funds are typically fairly cheap, as you know. So there will be additional pressure on those managers who are actively managing portfolios to distinguish themselves. So you will see the emergence alongside the growth of advisors in India of low-cost index funds and portfolio construction. But the relative value of the top quartile, second quartile, large cap funds, I think will continue to probably have a 2 or 3% alpha over time. I think some of the numbers you showed unnecessarily flatter and exaggerate based on mandate drift, and I don't think they should be taken as examples of the type of alpha that you can expect going forward. But against a total return index and net of fees, if you can still generate 150 to 200 basis points of alpha, that would be considered a very healthy outcome anywhere in the world, particularly when you take in the benefits of compounding and imagine yourself holding a portfolio over 8 or 10 years that has given you 150 basis points year on year. I think you can all compute what the benefits of that might be. So absolutely, we will continue to focus our core skills on building active management, certainly at UTI. But we'll also build and manufacture index products and ETFs because we know that there's going to be demand for them from advisors constructing portfolios at low cost.
All very valid points. And yes, as we stated then too, whatever the returns have been shown need not be what could happen in the future. Maybe the point is well taken too. A 20% return could well be considered an exceptional case, and that's not something that people should hope for when they're investing in mutual funds as well. But good having you on the show, Mr. Puri. Thank you so much for taking the time out and speaking with us today. I look forward to have you more often on this forum.
Thank you.
That's the view from Leo Puri of UTI AMC. Now, I think some very valid points out there. The only question mark to the minds of an investor is that if indeed now a mutual fund manager or a mutual fund house will, and the returns that come in from the scheme will therefore look slightly more compressed than what they otherwise would have. What are the options, and should an investor change his or her investment patterns? I don't think the answer to that is yes, but let me not say that. Let's ask an expert about that. Harshvardhan Roongta of Roongta Securities joins us right now on the show. Good having you, Harshvardhan. Thanks so much for taking the time out.
My pleasure.
So now some of the schemes which hitherto would have looked great in terms of outperformance will start looking slightly not so great, but not bad, of course. Does any investor have to worry about his existing investments or her existing investments because of these new norms of TRI?
So, well, not really. You don't really need to go back and look into in depth to understand whether you've done something right or wrong. Let's understand a common, phenomena. One is, if you are investing in an actively managed fund, there is always going to be an apprehension in your mind whether the scheme that you have invested into is beating its benchmark or no. Now, what will it do in the future? It's only going to be known after that time period has gone by.
Yeah.
The important part is, if you just refer to the Morningstar study, a report that has just come out with, comparing the schemes that have beaten their benchmarks in the year 2017. So when we looked at the comparison, when they did with the PRI, the price return index, if the numbers in a large cap category, there were 45% of the schemes, beat their benchmark. The moment the comparison was done with the TRI, the numbers came down to about 36%. Now, this is a huge point. I mean, it's not something that can be ignored. Why? Because if you're investing in an actively managed fund, you're paying a higher fund management cost.
Yes.
What do you want out of it? As an investor, you would want to beat the benchmark. And if that percentage is reducing by almost 10 percentage points, which is quite a large number.
Yes.
So as an investor, you would certainly want to look at, why should I not invest in a low cost fund?
By that you mean?
By those terms, unless I'm reasonably sure the scheme that I'm investing in is going to beat the benchmark, which is in this context a 36% chance.
No, so the low cost fund is what? That would be an ETF.
Absolutely. So now look at it from an investor's point of view. I mean, if I am going to make an investment, I'm going to think first, what is my cost of investing? So that is essentially the fund management cost. Now, in an actively managed fund, where we see an average cost of about 2.5%, in an ETF or in an index fund, for that example, would be 1/10 of that.
Right.
So I am going to look at it and think about it. If I'm going to pay 10 times more the cost, like an index fund would typically charge a 0.25%. Against an actively managed fund, which is charging about 2.5%. So as an investor, you might want to look and think, why am I paying that extra 200 basis points? Why am I paying 2 percentage points higher? Or why am I paying 10 times more?
Of course,
even
if
my fund manager is not going to beat the index, and if he's going to beat, and it's a future call that we're taking, what is the percentage of actively managed funds which have beaten the benchmark? In this particular example, it is 36%. So 36% of all the mutual fund, all the large cap funds in this particular category, only 36% have beaten the benchmark. Now, what is the probability of my investment, the scheme which I have invested, to be in that 36%?
Sure.
So when the probability of the scheme that I've invested in is less than 50%, then I'd rather stick to a benchmark.
So, okay, let me ask you this then. To your clients who might be asking you for investments into large cap funds, strictly large cap funds, are all of your recommendations within these 36%? And if not, for whatever reason, if not, are you recalibrating that whole equation?
So, well, we've been, a huge advocate of index funds since a very long time now.
Okay.
So, unfortunately, the numbers were not favoring our recommendations in that context. So, if we were recommending index funds since last 5 years, I mean, we had seen that actively managed funds, some of them, or rather 36% in this particular context, have been able to beat the benchmark. Okay, so, and fortunately, we've been able to pick those schemes as well. The schemes that we've picked have been into those 36%. So, as a part of the allocation, now, are we saying that the entire corpus should go into index funds? No, that is not the recommendation.
So, what's the ideal percentage?
So, ideally about a 20 to 25. This has been our recommendation even earlier. Ideally about 20 to 25% of your equity allocation, not only large cap. We're talking about the equity allocation should be in passively managed funds, which would be index funds in that context.
And then the remaining 75% is distributed how? How much of the remaining is into large cap funds?
Okay, so let's look at it like this. You have 100% allocation to be made, so 100 rupees to be invested into equities. Now, this is not considering the debt component and all these things. I'm saying the 100 rupees is what is going into equities. Now, within that 100 rupees, you would create a core portfolio. The core portfolio would mean that you have about 50 to 60% of that money, which is 50 or 60 rupees out of this 100 rupees, would go into a quality portfolio, the blue chip established companies. Sure. Now, when we talk about blue chip established companies, these are large cap in nature.
Yeah, so the passive fund could actually take care of that.
So, no, so a 50% would be, say 50 rupees out of the 100 would be in a large cap fund, of which you invest 25% in passively managed. And 25% in active.
Okay, and the remaining based on your risk appetite, you can distribute into mid-cap, multi-cap, micro-cap funds, so on and so forth.
Absolutely.
Okay, great. If I may, Harshvardhan, what's an example, or is there a passive fund that you guys have been really bullish on or have been advocating for a while now and is good enough for somebody who's convinced by argument and wanting to invest into a passive fund could look at?
So we've been recommending the IDFC Nifty fund. So basically it has a fund management cost of about 0.25% and a direct plan would have much lesser. So the question is, if you're investing into a basket of 30 companies or a 50 company, Nifty for that example is a 50 companies. So this is a fund which helps you get access to the best of the companies across the country. It's an actually diversified portfolio because the Nifty represents all the sectors in the economy. The good part is, again, if you're looking to invest in an equity fund, you would want your money to be invested in equities. Now, when you look at actively managed funds, currently, because due to market valuation, perceptions, we've seen that the best of the schemes have had more than 10% of their corpus in cash. They're not invested. So if the market goes up, that 10% lags. However, so they're not fully invested at all times. It could be good and bad both at the same time. If the markets fall, this is actually a good thing to do. The question is, if I am investing in equities, I do not miss out. I do not miss out on the actual developments in the economy. Like 2008, for example, when we'd seen that all the fund houses were taken unaware when the market suddenly turned around. And at that point in time, when you're underinvested, it actually causes a lot of harm to your portfolio.
Sure.
So at this juncture, a 25% allocation out of your 100 rupees can definitely go into a passively managed index fund.
Okay, that's an interesting and a slightly different conversation that I've had from what I've had in the recent past. And Harshvardhan, many thanks for giving us that thought process as well. There's some other recommendations that came up on your screen as well. Remember, these would be illustrative. Harshvardhan would recommend these, maybe some other funds as well. And the last one on the screen is, by popular demand, what a lot of people are asking us for is a recommendation for an ELSS, and I think Harshvardhan recommends the Birla Sun Life Tax Relief 96 plan. But out of time completely on this leg of the Mutual Fund Show. I take a moment to thank Harshvardhan for joining us on the show as well.
Pleasure.
And viewers, thanks for tuning in to the Mutual Fund Show.